All right, what is up, world? Welcome back to Rogue Macro. Check out roguemacro.substack.com. We're going to be watching the FOMC drop here today. Should be coming up at 2 p.m. You can see March 18th. It was St. Patty's Day yesterday, so happy St. Patty's Day, everybody. Hope you had a good old time. All right, let's jump into, let me see. Let's go to the charts real quick. We'll take a look at the charts. Stand by 1 second. Had to yell at my kids. They were yelling in the other room. So, okay, let's go over the charts. Before this drop, in about 7 minutes from now, Bitcoin has pulled back. I talked about this fake breakouts that we've seen over the last six months, 12 months or so. So be careful. I said to be careful of those in my most recent blog post on bitcoinandmarkets.com. So we will be watching that, but it does seem to be coming back a little bit here. I think it went as low as 70. Let's see if we can blow this up a little bit. It's coming back a little bit, but nothing significant so far. The last time we had an FOMC was right before this big drop. Okay, and that FOMC decision was to hold rates stable. So that's kind of what we're looking at here, but I don't think we're going to have nearly as big a drop if we have any more drop than we just had. I do feel like the market is putting in a bottom, has bottomed pretty substantially. I mean, we've had consolidation now, multiple levels, multiple times. This has to come to an end sooner or later. Okay, let's take a look at the broader market. Gold down over 2% today. DXY is holding stable, up about 0.2%. US 10-year is slightly higher, 0.5% higher after selling off earlier this morning. But really, I mean, if we pull up, or when was the last one? January 10th, I think, was the last FOMC meeting. Am I right about that? Let's take a look real quick at this calendar. No, January 28th. I was way off. Okay, so January 28th was right here. If you guys can see that. So we are under where we were last FOMC meeting, which is interesting for the 10-year. If we bring up the 3-month and SOFR, we can slap some of these on here. So we have SOFR in blue, the 3-month, right within the FOMC policy range, not telegraphing any sort of raise or cut. It is slightly higher than we would that is normal. If we go back to another period where we had a long time, you can see SOFR is at the bottom part of the range. The 3-month was kind of at the top half. Here, they are both at the bottom half, and today they're both at the top half. So it is slightly more biased towards the top, but there's no sign here really of any sort of unexpected raise. Now, if we go to the time check 4 minutes, if we go to Fed Watch and it makes sure this is, yeah, I'm going to share this different screen with you guys. So if we go to Fed Watch, we see it's at 99% of no cut, no raise, 1% chance of a raise, which is very interesting. That would match with the chart that we were just talking about. A slight maybe bias to the upside, but pretty much this is pricing in no cut right here at all. So that's that. Let's take a look at stocks. Stocks are slightly down on the day. We did have this kind of top rolling over top, rounded top. We'll see if that continues, but overall, it's been like I have these arrows in here for the last several months. It's 6 months. It's been very stable, a little bit up, a little bit down, a little bit up, a little bit down, and that's where we are right now for that. Let's take a look at oil because, of course, this is all of the rage right now with what's going on in the Strait of Hormuz. You can see that we are, if I put this right on the price right now, we are 20% off of those highs back here on March 9th at the height of the early conflict, down 20% from there. And today, US oil is down almost a percent going into this FOMC meeting. Brent crude, which is more of a global market, that is up. You can see 106. There is this divergence happening here between foreign crude and US crude. There's probably going to be a divergence as well. 2 minutes until or on the European versus the American natural gas contracts, because a lot of times what's going to happen, or what a lot of people are speculating now, is that some of these exports, because Russia, they've sanctioned Russian oil, Qatar's now offline with their oil production, sorry, their gas production, and the U.S. is really the only big game in town. It is the biggest producer as well, but it could be that we're going to keep it in the United States and really not allow as many exports. That way we keep prices down here. So, natural gas is going to be an interesting market, maybe even more interesting than oil, to be honest with you. But okay, so we are 1 minute away. Let's go back to um, the calendar. You guys can find this just by Googling FOMC calendar, and it will be the first result. We are 1:59. This should drop at 2 o'clock. Guys, join me here for all of these type of live drops of FOMC and CPI. Usually I live stream, about 50% of the time. So make sure you guys are following me for that. Also, if you're watching me on YouTube or on Twitter, like, comment, subscribe, follow, do all those things. You can find the Telegram community in my bio. So all of those things. All right, 2 o'clock, refresh. We have the March statement is out. We can zoom down here. The committee decided to maintain the target range of federal funds at 3.5 to 3.75%. Okay, so no cut, no raise. Let's go back and take a look at what's going on, how the market is responding real quick here. We can go down to the 5-minute. Stocks starting to move positive on the news. We'll be watching this. Still down on the day. US 10-year coming down. Very interesting. Let's go to the 3-month. I like the 3-month time frame. Some people use 3-month. Some people use 2-year as like the shorter end. 2-year coming down hard. You can see this on the news of no cut, no raise. All right, so that's that. How about SOFR? And we have to go out to the daily for SOFR. And we can't really tell how that's reacting to the minute. Let's go take a look at some other things. How about DXY? We'll go down to the 5-minute here. DXY falling down a little bit as yields are falling. DXY is falling sympathetically. A lot of these reactions, though, we have to take with a grain of salt, and they reverse. There is a market reaction, and then that market reaction gets reversed quite quickly, by the end of the day, even by the end of the trading day. So we will see what happens. Gold, we already looked at that. Oil coming down hard, 94 now, US oil. WTI, West Texas Intermediate. Oh, and I need to be sharing these tabs, guys. Oh my gosh, it's like a newbie streaming here. Okay, so DXY, that's what I showed. Gold, I showed. What else did I show? S&P 500. Again, initial minutes was higher, and now it's coming back down slightly. Still positive since the announcement. We will see where this ends up. And oil coming down hard. Again, $94 now for US oil. Okay, let's go back to the statement and let's read through some of these things. So one thing I do here, guys, is I react to all of these, all of the FOMC stuff. I'm not like a Fed whisperer or anything. but read and I watch all of the press conferences. I kind of my through my lens, my contrarian kind of unique macro lens, I take a look at what they write, what Powell says, and I kind of interpret that. All right. So that's what we're gonna be doing here. Like, comment, subscribe. I want to know what you guys are talking about. Let's see if there's any comments from Telegram yet. Not seeing any. Okay, so let's read through this. Make sure my screens are sharing properly. All right. Available indicators suggest that economic activity has been expanding at a solid pace. This is true. This is very true. One thing that I tweeted out recently, let's see if I can go find this real quick. Share this tab. And trucking volumes at a 4-year high, up 10% year over year. Ignore the noise and focus on the signal. The freight market is telling us that the domestic economy is strengthening, not cooling. And I do agree with that. One thing I've been kind of pounding the table about is this reindustrialization trade. I created um, a unique portfolio to invest over the next 5 to 10 year time horizon in the reindustrialization of America. And you guys can find that at roguemacro.substack.com, available to the pro tier over there on that. Okay, let's go back to the statement. All right. So we confirmed that it is expanding at a solid pace. This isn't the Fed trying to pull the wool over our eyes or anything. The economy has been expanding at a solid pace, and especially the U.S. economy relative to others. So when we talk about this Strait of Hormuz fiasco that we're living through right now, um, overall, the rest of the world has much more to lose than the United States from a Strait of Hormuz. So if you're saying that the U.S. didn't plan for this, okay, no, the U.S. definitely planned for it. They've been planning for a shutdown of the strait for 40 years. And the dynamics of war, the dynamics of this situation is adapting real time. And Trump is adapting real time to these things. He's put out some really great strategic moves over the last few days, inviting other countries to come in and secure the strait because they have more economic interest than we do in securing the strait. And now they're talking about, hey, should we really even secure the strait? Like, if nobody wants to secure the strait, why do we want to secure the strait? So this is all part of this deglobalization. And I've been talking about deglobalization for years, even when people laughed at the idea. I was saying we're going to deglobalize. This was still when the IMF and Christine Lagarde and these people were laughing at this idea of deglobalization. And what's going on 3-4 years later? Deglobalization. We're in the midst of it. And this move, but in the Strait of Hormuz, the dynamics of war, opportunities arise, synergistic type decisions and strategies can appear. And that is an opportunity for the United States. And now it looks like, hey, we're taking the opportunity to say, you guys have to secure this. We don't have really, we have like 1% interest in securing, because 1% of the traffic in the Strait of Hormuz is U.S. traffic. We have 1% interest. So if you all want this strait to be open, you have to come and secure the strait. So that's what's going on. Anyway, let's continue with job gains have remained low. That is also true. And unemployment rate has been little changed in recent months. All true. Again, it's a very weird market. It looks like it's going to deteriorate, and jobs are kind of deteriorating. We see big layoffs coming from some of these big companies, but the unemployment rate has not really budged. Is that because the labor force participation rate is changing? Possibly a little bit. Is that because there is some effect from deportations? Probably some there as well. But overall, this is a weird market. We've been here for 3 years. Remember, the PMI, which is the Purchasing Manager Index, that is a proxy for the business cycle, booms and busts, expansions and recessions. It has been in mild negative territory for a long time until the last 2 months. And so that is saying that we've been kind of in a semi-recession for 3 years. It's a very weird period, and there's no example of like that in the in that series of data going back to 1948 in the PMIs. So this is a very quote unquote weird market, and the Fed is putting their thumb on it kind of right here. Inflation remains somewhat elevated, 2.4%, coming down. Trueflation has been under 1% for much of the last month. I think it's back up above 1% now. So that's inflation remains somewhat elevated, maybe depending on the way you measure it. This, of course, would be price inflation and not actual inflation, which is an increase in the supply of money, inflating the supply of money. I would say that's somewhat down. Um, we're experiencing disinflation in actual uh, increase in the money supply. This inflation is due to a lot of different things. There have been some talk, obviously people were worried about tariffs. There's been studies now done on the effect of tariffs on the price level, and it's like less than 1% or something like that. 0.8% is the amount of the effect of the tariffs. Now, how can that be? A lot of people think, oh, there's a 25% tariff on this good. How can it only affect the price 1%? Well, because there's different elasticities. Okay, there's a substitute effect as well. Like, how much does the price have to increase for you to go to a different product of the same sort of good that's maybe US based, or doesn't have the tariffs on it? Another thing would be that there is this elasticity of demand for imports. So every 1% that tariffs go up, the empirical evidence is that the demand for that product drops 3%. So every 1% tariffs go up, the demand for that product or for that import drops 3%. So if it's going up 10%, you're looking at a 30% reduction in demand for that import item. Okay. That is due to substitution. That's due to simply just not buying it. A lot of the stuff we get from China is not necessarily um, necessities, right? We are self-sufficient in food and energy, the two most important the two most important necessities, while China is dependent on outside food and energy. So they are much more dependent on the global system than the United States is. Tariffs are going to hurt the US much less than they hurt China. Okay, let's continue reading this. The committee seeks to achieve maximum employment and inflation. Okay, that's their dual mandate. Uncertainty about the economic outlook remains elevated. That's, stating the obvious. The implications of developments in the Middle East for the US economy are uncertain. Okay, that's brand new. They actually mentioned that. So that will probably have some effect on the algos and how these algos are pricing this. The committee is attentive to the risks on both sides of the dual mandate. Okay, so they're going to have no cut, no raise. In considering the extent and timing of additional adjustments to the target range of the Fed funds rate, the committee will carefully assess incoming data. Yep, yep, yep. The committee is strongly committed to supporting maximum employment and returning to our 2% objective. In assessing the appropriate stance for monetary policy, the committee will continue to monitor the implications. The committee would be prepared to adjust the stance. Risks emerge, blah, blah, blah. Committee's assessment take a wide range of effect. Labor market pressures. Okay, still no mention of QE. They are still doing their balance sheet facility, or no, what was it called? Reserve management, reserve management something. I I predicted that they would call it that. So in a blog post, several weeks to a month before they came out with that, naming that, I said, hey, they're going to probably come out with some QE, not QE, and just call it reserve management facility. It's not reserve management facilities. Some it might be program, reserve management program, something like that. And yeah, so they are doing QE at a significant pace, something like 40 billion, I think, a month. And they don't have any talk about that at all in here. So very interesting. Let's see if I can find that real quick. Okay. No, no. No, 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 no. Okay, let's see. I think this will be it. And if we zoom in here over the last few months, you can see it's coming back up week over week. They're doing, let's go to month. So we could go to, we'd have to go this month, but there's a little uptick there. That's kind of, let's do this 6.5. Man, so they did about 100 billion here. Is it my no 87 to so about 40. Yeah, it's about 40 billion, 40 billion a month. It looks like they're doing on this reserve management facility. So there you go. All right, let's go back to the charts and see what's going on with prices. I'll see if there's any comment. All right. What were you guys talking about here? Do. Ah, I see what you guys are talking about. Bringing up the Charlie Kirk stuff and Joe Kent or whatever his name is. Okay. All right. So, big little bit of reaction here from US oil up back above 95. Stocks are selling off now on this. They were going higher, now they're selling off, but still pretty stable for the day. Looks like it started here, so it is down on the day, but has been stable over the last couple hours. Let's take a look at the US 10-year. After initial sell-off, coming back up, just like I said, they tend to do this. Dollar down, now back up as well. Gold still down on the day to over 2%. Let's take a look at Bitcoin. Bitcoin went up on the news, back down, kind of testing 71.7, but we'll see if that recovers quickly. I think it probably will. All right. So that's all I have for the reaction to the FOMC. Like they didn't surprise the market. Let's take a look at this. Remember, they didn't surprise the market. 99% they were pricing in that there would be no cut, and it came in as no cut. And I've said for years and years and years that they will not surprise the market. They will not surprise the market. That's why we looked at the 3-month and SOFR and said, look, these are right here. Maybe a slight bias to the upside, but really it looks like they're not going to do anything. And they're not going to do anything because guess what? It's pretty easy to be the FOMC chairman, the Federal Reserve chairman, and member of the FOMC because they every time they just say, "Do what the market says, do what the market is expecting." Let's take a look quick at a couple of these more future ones. How about April? What are we looking at? No cut in April either as of right now. No cut in June. No cut in July. That's different. I think that July was the first one. Even no cut all the way out to September. October is the first time that it gets barely under 50% for no cut. And it looks like we'll have one cut by October at least. And then December, the last one of the year. This would be our current. Let me make sure that's coming through. And then I'm showing properly here to everybody. Let me make this, put this over here. Okay, so 1 month over here. This is the current level. So this is all the way out to December. The prediction that the market is pricing in right now, 2 cuts by December is the majority opinion. So that's what we got. Let's go back and see. Did we get an SEP? Yes, we did. So let's bring this up. Okay, SEP. So actually, I like looking at the PDF version. So let's bring that up instead. And I'll try to zoom in here. Summary of economic projections. All right. So we have here is the change in GDP. The median was 2.4% this year, 2.3% next year, and 2.1%. Longer run, 2%. I've talked about this a lot, that GDP at 2% and PCE at 2% is not a coincidence. Okay. In a credit-based system, these two things in the long run are identical. So, or they tend to be very similar. So 2% for GDP in the longer run, 2.4% this year. Last projection was 2.3. So they have gone up slightly in GDP projection for this year. They've gone up quite a bit for PCE this year. So from 2.4 to 2.7% by the end of the year for the PCE measure of inflation, which is pretty big. This is saying that they're expecting inflation. That might be why some of those future pricing of more cuts is getting pushed further and further out in the future, because this is showing a little bit of a reacceleration in price inflation. I don't know if I really see that or not, but we will cover that more in the future. Core PCE, slightly above from 2.5 to 2.7, same sort of thing. And the Fed funds projection. Okay, so by the end of the year, they predict 3.2%. Or sorry, 3.4%. And the current is 3.75 to 4. So the next one cut is 350. So 3.5 is one cut, and then 2 cuts is 3.25 to 5. So this is expecting 2 cuts. That's exactly what they expected last meeting as well. They are still forecasting 2 more cuts this year, 1 more cut in 2020. Excuse me, 2027, 1 cut in 2027, and no cuts in 2028. And the long run, quote unquote, neutral rate that they're looking at is slightly higher than they had last month, or last SEP, which comes out every other time. So that was 3.0. This is 3.1%. So slight uptick in the Fed funds projection, but still this is 3 cuts. Again, 2 cuts this year, 1 cut next year, no cuts, longer run, 3 cuts from here. So that's what we're looking at. This is the central tendency. Take a look at the different ranges that people have. Let's take a look at the range for, let's first do GDP. So this year, the range was 0.2, or sorry, in December, it was, it just has moved up 1. How about PCE? Okay, so PCE has moved up quite a bit. The upper range last SEP was 2.7. Now it's 3.3. So there is at least one member that put their PCE range up at 3.3, expecting a much higher rate there, and that could affect this average number. So yeah, somebody is expecting, because see this the central tendency excludes the three highest and three lowest projections for each variable. Okay, so this central tendency, that shows you that there's probably one person that has a really high inflation estimate, but that did increase quite a bit from last time. So the central tendency you can see here for PCE was much tighter, 2.3 to 2.5 in December. Now it's 2.6 to 3.1. So this central tendency has increased a lot, but there is one or two people that are way up here at 3.3. Very interesting. All right. So that's the story here. Let's see, it's 2:24. They should be coming on. Maybe we'll just listen to the first little bit of this press conference. Let me see if there's any more comments here, guys. No. Okay. Well, let me start setting up here for this. Just a second. All right. Share screen. All right, so we're waiting on these guys. What else can we look at? Let's look a little bit more at the charts. 666. Uh-oh. 666677. Not a good sign for the S&P 500. Just kidding. Let's see what STRC is doing. 99.77. So they aren't issuing any new STRC. All right. Well, we're gonna put it on stocks. Let that go for a minute. Put your question comments in the chat, guys, on Telegram, or if you're watching on YouTube or Twitter. Otherwise, we will just be waiting for this FOMC conference. All right, let's do this. Okay, so here is John Conrad, big guy in shipping. Let's read through this tweet of his. So let's unpack this. He's responding to Trump saying, I wonder what would happen if we finished off what's left of the Iran terror state and let the countries that use it, we don't. We're responsible for the so-called strait. What would it what would get some of our non-responsive allies in gear and fast? DJT. So Conrad is responding to this. Let's unpack this. What if the White House was has no intention on reopening the Strait of Hormuz? What if this war is really about ships and tariffs? I don't think the war is really about ships and tariffs. I've talked about this. I do think this was um, done because Trump and the administration wanted to get rid of a terrorist regime that was anti-America and funding things around the world. I think that's exactly why they went in. It, but like I said the other day on the live stream, fortune favors the bold, or um, God helps those who help themselves, or whatever the case is. That do a good deed and you have synergies from that, right? And so I think that's the case here, is that they went in, the primary objective is to get rid of this terrorism, uh, this terrorist state, and then it has synergistic effects in deglobalization, which, I mean, the goal, there is a broader goal, or a broader at least trend, of deglobalization, and all of these things work together. So there you go. I had a long discussion with a senior Department of Energy, DOE, official yesterday on background. I can't share any details, but it's clear everyone's Strait of Hormuz calculus is wrong. And I think it's crazy because so many people think they know exactly what's going on here. So many people know that they didn't plan, that there was no plan for this. The 40 years of planning isn't really planning. And everything should be executed 100% perfectly all the time, and that what's happening right now is a because we didn't plan. That's absolutely crazy. We don't know what's going on, we don't know all the dynamics happening, but we do know that it is a dynamic environment. And so, yeah, the Strait of Hormuz stuff, the Strait of Hormuz calculus is wrong. We need to go back to the drawing boards. That's it. That's the tweet. All right. We got Powell up. Let me get back to him. Don't worry, we're going to rewind it here. All right. Let's see where he came up. Here he is. How's the volume? We went over all this. Okay, the housing sector remains weak. That is also the case. I saw that mortgage rates are going back up. Yes, the housing sector does remain very weak. And deporting millions of people is not going to help the housing market either. Um, Not that they are in the market necessarily for the same sort of houses that American middle class are in the market for, but it's all relative and it all has an effect. And so there is an effect on the availability of housing if we are deporting to, if the net change of total population is negative. So we have had negative immigration in 2025, and 2026 will probably be the same. We'll probably have negative immigration. Now, the total population is still expanding in the United States, but not nearly as fast as it was, say, 2 years ago, 3 years ago. Um, but there's a lot of housing starts. People are still building new homes, and so anyway, the housing market is very soft, and I really don't know what to expect over the next 5 years for that. There's probably going to be something's going to culminate into a sharp decline and then recovery after that. But what exactly that looks like, I'm not sure yet. But okay, here's the real change in GDP. One thing we've talked about in the past is just how perfect it just settles in. Remember that? Like, oh, we just there's no real, it's all groupthink. They just think it's going to glide back down to 2%, which is roughly their goal, and everything's nice and hunky dory. Everything is going to respond perfectly to their goals and what they see. But this is like there's not even one person that sees a real pickup in GDP or a real slowdown in GDP. Not a single member is going outside this very narrow band of grouping of these predictions. So this is major groupthink going on the FOMC. Okay. So one thing people are calling this, which I think is pretty cool way to just sum it up, is um, low fire, low hire. So not a lot of people being fired, and there's not a lot of people being hired, and so the unemployment rate is just kind of static, and that's look how flat it has been in the past several years. It really between 4.5, and 3.5%, fluctuating all the way back to 2021. And so, yeah, this unemployment rate, again, I'll keep going back to it. We're in a weird period, guys. A weird period for macro, a weird period for the economy. Okay, one thing I was thinking about when he was talking there is, he's supposed to be apolitical. So we'll see how much, and he does a good job of trying to stay apolitical. The tariff thing, I think, really put them, that's a losing proposition for the Federal Reserve. They should have never let tariffs be part of their monetary policy, at least stated uh, concerns, because tariffs are political. And if you're trying to mitigate the effect of tariffs, that's a political statement. That's a political position. And that opens up the Fed to threats to their independence. So they should have never talked about tariffs. At least they could have mentioned it, but they should never have said that it was part of their monetary policy calculus, um, because it put them squarely in face to face with the Treasury Department, with the administration, with the government, and saying, "Hey, we're fighting you. We're fighting your effects of your tariffs, sir." Um, anyways, I do think that maybe over the next 4 to 8 years, the next two terms of the next Fed chairman, right now it looks like it's going to be Kevin Marsh. Uh, if that's the case, I think it's possible that the Fed loses more and more of its independence. And looking further down the road, I'm talking maybe 10 to 20 years, I don't know if the Fed will disappear completely. We would have to have a major change, a major shakeup for that to happen. Maybe a world war, or something bigger than even what we're experiencing right now, bigger than COVID. I would say it would have to be bigger than COVID and this what we're experiencing right now with the Strait of Hormuz. It would have to be bigger than both of those two things combined for us to talk about actually really revamping things and being able to get rid of the Federal Reserve. But what can happen is that they will be subservient to the Treasury. They will lose independence. They will still be there, but the chairman will be a Treasury person instead of the chairman being a Wall Street person or being a Goldman Sachs person or a BlackRock person, whatever. The chairman of the Federal Reserve is going to be a Treasury guy. Okay, I can totally see that happening even 4 to 8 years from now. So it will effectively be ending the Fed. It'll be ending the Fed independence, which is kind of the point of the Federal Reserve, right? So we'll still have the window dressing of the Fed, but it will lose a lot of independence. And actually, this goes toward a more authoritarian system. And I'm not talking like necessarily a hardcore totalitarian system. I'm talking about more authoritarian. So if you look at Japan, right, the BOJ is not really independent. It's not independent. During their whole boom and bust, their whole boom, and then the missing 30 years in Japan, all of this was done through window guidance, through the guidance of the Ministry of Finance, down through the BOJ and to monetary policy. So they don't have an independent monetary policy. China, oh my God, are you kidding me? Do you think the PBOC is independent? No. The ECB. The ECB is maybe more independent, but it's totally globalist run. So it's not really independent. It would be as if the Federal Reserve let a bunch of wokies onto the board of governors. If we got in there, Raskin, what was her name? Sarah Raskin, in as vice chairman, and then we got a bunch of wokies on the Federal Reserve Board. That's what the ECB is. So they're not really independent either. They're totally ideologically captured by activists, political activists, and the US and the Fed, they still have somewhat of an independent Federal Reserve from another faction in the great power game, that being the moneyed class, the Wall Street class. So you have the Wall Street class, you have the globalists, and you have the people. And those are the three factions that I have in my mind whenever I look into things and think about the way things are going to develop in the future. So one thing after COVID, that money class, the banker class, they got scared from the political activist globalists. And so then they backed the people. They actually backed Trump and his reelection and stuff like that. But now they're getting into the point where they're seeing, okay, well, this is a populist uprising. We're going back towards deglobalization, and that's what we're in right now. And so they have to say, there's going to be some breaking with the people, some breaking with the administration, but they're not going to go back to the globalists. I mean, they might play them off each other. They might do this or that. But Right now, that's where we're at. And if the Federal Reserve loses its independence and becomes more authoritarian, that's not necessarily a bad thing. I mean, it is a bad thing, but look at how did one thing I've talked about recently is the miracle economies. So you had the Japanese miracle, you had the tiger miracles, you had the Chinese miracle, of course. If you go back to post World War II, you had the German miracle and the European miracle, building them back up. Okay. And all of these things were done not with a purely independent central bank in these places. It was done with a more authoritarian bent towards directing of investment and all this. When you talk about Michael Pettis, he brings up that look, the the CCP is they're funneling investment towards the manufacturing sector versus the household sector. They're not the household sector is subsidizing manufacturing. And so the household sector is getting bled dry. That's why they have so low domestic consumption because people don't have any money, and the money they do get, they squirrel it away. They don't really spend it. They have a high savings rate, low spending, low consumption rate. And that is by design. Okay. And it has led to this great boom out of China. Now, if the US goes more authoritarian on the central bank side, guess what? We're going to experience that same boom. And part of my whole theory over the next 5, 10 years, and part of the reindustrialization portfolio is that we are going to have more directed investment. Consumption as a share of GDP is going to go down. Investment and manufacturing is going to go up. It's going to be a miracle economy like Japan experienced, like China experienced, like Europe experienced, except this time it's the US's turn to have a miracle economy. And I don't know where I started this rant, but that's where I'm going to end it. Let's keep going. PCE. Again, groupthink. Look at this 2028. The group is so tight. We have that brought up, don't we? Let's see. Yeah. So what is that range? We're talking about PCE. That range in 2028, 1.9 to 2.2. 1.9 to 2.2. That's what this range is right here. Nobody is thinking outside the box. Nobody's thinking that it could be higher or much lower. Look at this is groupthink at its finest. Mhm. Yep. That's true. That's true. But remember, when you evaluate these things, um, higher energy prices, even if they're temporary, they will have a temporary effect on overall prices. For sure, that's true. One of the best correlations to CPI is oil prices. And so, yes, but you have to think of it as a a trend in supply and demand. So this temporary disruption does not, I mean, it can change the supply numbers if you say, okay, they have to close up these wells, and then that's going to cause some damage. And after they open up the wells again, it's going to take a year or two to get them back up to producing as much as they were, or whatever. Maybe they have to drill new wells. So there is some like fundamental issues, but overall, the supply, we know where the oil is, we know how to get it out, we know the general cost per barrel to get it out of the ground in these different places. More and more is promising to come online. Venezuela is promising to go from 1 million barrels per day, which is what they were before Maduro was nabbed, to as high as 5 million barrels per day just in the next 3 to 5 years. US is continuing to hit new all-time highs. It's slowing down, but we're right about 13.8 to 14 million barrels per day coming out of the US. That will probably continue to go upward. We have Iran. If Iran's regime gets overturned and we have the friendly Persian people being in charge, and the U.S. is in there helping them get their oil and gas industry back up, then that could go from whatever they were producing 1 to 2 million barrels per day up to five as well, maybe even as high as eight. If you go out 5 to 10 years, they could probably get up to about eight. And so we have all this promised new production that could come online. So overall, that's the supply story. What's the overall demand story? It has two parts. It has two parts. One is a negative effect from demographics. The other is a positive effect from AI and AI energy needs. So, and a lot of those energy needs are not going to be fulfilled by oil. They're going to be fulfilled by natural gas or nuclear, but natural gas most likely for the most part. And so uh, that is those are the two stories: demographic decline and AI advancement. That's the question. That's the demand side question. But the supply side is um, much more obvious. This is a temporary disruption. It's not going to affect the overall ability to supply the market with over 100 million barrels per day. And so long term, it's it's still set up to have generally falling prices over the long term. We will have these periods like we're having right now where there are disruptions and financially they price up the oil. Um, but nobody right now even is dipping into their reserves from what I know. Japan hasn't started hitting their reserves. China, I think I saw a tweet today saying that we might see the first downward movement in their reserves uh, over the last few years, just now, coming up at this month. But for argument's sake, the reserves haven't inventories haven't even been tapped yet. So there's still a long way to go on this whole disruption story and what the actual effects of this are. But he's right in general that from the financial side, this will have a upward pressure on price inflation. It's actually a downward pressure on money creation because as you have higher oil prices, depresses economic activity, which depresses the overall demand for oil. And then you start talking about oil or demand elasticity for oil and all those things. It gets a little bit more complicated, but um, overall, in the short term, there is a financial force or financial effect towards higher price inflation. But long term, it's still locked in that it should be gently falling prices for oil. All right. So again, groupthink. There's nobody thinking it's going to rise above four, need to rise above four, need to go below two. It's just going to be nice, smooth glide path. Sure, sure. So what's amazing, guys, and I've talked about this in the past too. So all of these different things to hit COVID, tariffs. Now we have the Venezuela, we have Iran. All of these shocks, and what is the culmination? The FOMC basically keeps mark rates the same or cut 25 basis points, keeps the rates the same, cuts 25 basis points. If it's priced in by the market, we'll cut 25. If it's not, we'll just hold rates. So all this dynamic stuff going on with the global economy, with price inflation numbers, with GDP ups and downs, with crashes in China, with demographic problems everywhere. And the result is the Fed doing nothing. Isn't that amazing? And it's not analysis paralysis. Like some people might say, oh, this is just because they can't decide what to do, you know. They have too much information, they can't decide. No, that's not what the case is. The case is that they're not looking at the proper information, or they're not looking at it in the proper way. They're overcomplicating it. Financial types like to do that. Financial types, macro types, um, financial analysts, all these people, they like to overcomplicate things. They're overcomplicating it. They're just holding rates steady and they go through so much data collection. I mean, I wonder how much the Fed spends meeting every meeting on data collection. It's in the hundreds of millions of dollars, I'm sure. And all of that money is spent to hold the damn interest rates stable. And the market priced it in. Oh, man. A half or 3% is based off tariffs. I don't know. I've seen the studies, like I mentioned earlier, showing that the overall cumulative effect is under 1% from tariffs. So he is saying that they come up with their own stories in their head to rationalize things. But what's funny is that all of those their stories are based off of the textbooks. They're all reading the same textbooks. They're all reading the same working papers. They're all reading all this stuff. They're all looking at the same models. They're all generally neoclassical at this point. And so, of course, they're going to be groupthink. Of course. I mean, if you got a Marxist in there and you got an Austrian in there and you got some other, a diversity of viewpoints, you'd have a much wider range of opinions. But they're all groupthink, all based on their own narratives that they're building in their head, but their narratives are based off of their textbooks. And one thing, like if I were on the board and they were asking me what I think, I would be pricing it. I would have priced in to my calculations deglobalization and the effects of deglobalization. I wouldn't be blindsided by tariffs. I wouldn't be blindsided by these other disruptions in the global shipping and things like that. I would be able to price that in to my calculations and my story and my narrative that I'm saying. But under a neoclassical perspective, they can't do that. They have to say, these are our numbers. What are our numbers telling us? They can't think outside the box at all. So remember, core is less food and energy. So it shouldn't have directly oil in it, but higher energy prices, higher oil prices trickle down to everything else. And so there will be an effect of the oil shock, even though it's the oil shock itself is not in core. That's what you're saying. That's not a very good look, though. They should know. They should have a very good idea. He was like, "Oh, nobody knows. They're just guessing." That's not a very good look. So disregard it completely. Again, what I was saying is very weird economy. I would say that Powell would probably agree with me on that, and he's talking about uncertainty, but I would say it's just weird. It's a weird time that we're living in right now. You do look through energy shocks. That's what I was saying up front, but he said it in very succinct, academic speak. You look through energy shocks. Well, that's what I was saying. It's temporary. There's no change, fundamental change to supply and demand from these energy shocks, from this particular energy shock right now. Yet, I mean, there could be, say, for some reason it drags on for a year. Yeah, there could be major implications. But right now, you should look through the energy shock. Bingo. Exactly. 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 So they want to see that it's not temporary. They want to see that there's no way that this wraps up quickly and the supply comes back online and oil trades back down to $70 a barrel. They want to see that it is at $100 a barrel for a significant period of time. That ties into the peak cheap oil stuff from Luke Groman. So peak cheap oil is that dynamic doesn't happen because there the like higher prices will beget more supply on the markets because the supply that we're getting right now is going up. So the break even is going up. That's peak cheap oil. And what he's saying right here is that break even for the current market is not going up. They're waiting to see if prices are sustained higher. So this all has to do with prices and speculation, and that's all driven on the facts on the ground, in the Persian Gulf and the Strait of Hormuz. So we'll see how this develops, but I still stand by that. It's going to be temporary. I mean, unless the U.S. doesn't want it to be temporary, unless the plan, like we kind of covered earlier, is that the plan is going to dynamically shift to say, hey, if these other countries want to open the strait, they're going to have to open it. I don't know if that's going to be ending up what they're doing because they are bringing some other assets into the area that looks like they're going to be really focusing on that coastal area, trying to suppress any sort of attacks on shipping. It's been 7 days since anything has been attacked. All the way back on March 11th was the last attack. And so it could be over. And they just blew up a bunch of different tunnel networks that had uh, tons of ballistic missiles and drones and things in that area. So like that capability to even do what they're doing is approaching zero. Now, does it have to be zero to open that strait back up? I mean, the strait is technically not closed. You could sail through it. It's not mined. You could sail through it. So it is open. It's just the fact that they don't want to risk it. So how close to zero does it have to get to start allowing that traffic to go through? That is a cost benefit analysis of the individual shipping lines and the individual captains, probably. So some captains might be like, screw it, put the pedal to the metal and let's just blow through this and let's get on our way. And they'll do it. They're more risk tolerant. But then there's going to be some captains and some companies that are highly anti-risk. They're not going to go until the risk is essentially zero, and that might take a lot longer, okay, because the risk can approach zero, but it's not going to be zero until this whole thing gets wrapped up, until the Islamic regime goes down completely and the people rise up and take back over the government and that area. They're going to have to take control of that area too, because it is mountainous. You could have small IRGC detachments hiding in the mountains, hiding in the tunnels, and that they just pop them, even though the central government is now Persian, or the central government is now de-Islamified. You might have these pockets that are still resisting. So the threat will be close to zero. How close does it have to get to have it open and have these ships go through? That is the part that's uncertain. Um, but I suspect that it will be effectively open in 2 weeks from now. Effectively. That's a big statement. By the end of the month, I think it's going to be open. A lot of people think that they're going to raise the inflation expectation to 3%. Mostly inflationistas think that. I don't think they'll do that. Powell pretty much shot that down right there. He continues to shoot it down every time he's asked. It's going to stay around 2% and or at 2% as long as they're independent. I mean, if they lose their independence, it could change that. But again, these shocks. He's talking about these shocks, this shock, that shock. 5 years we've gone through many different shocks, starting with COVID, yada yada yada. Well, they're only shocks because you failed to predict them, my man. And maybe look, your textbooks aren't setting you up for success here. No one knows for sure. Well, yeah, tariffs, I mean, in the very short term, they should they should tend to have a impact to increase prices. But once you get to these longer periods that he's talking about, 10, 11, 12 months, more than a year, you can start to see domestic production taking over some of those roles and even producing at a cheaper cost, not just disinflation, but actual outright deflation in some of these goods because now they're being produced locally and they've achieved scale and that they can start pushing down prices. So you could have tariffs. I mean, even like the textbooks would probably say this, that the one-time effect could be higher prices, but the long-term effect could then be deflation again, actually falling prices. So you have rising prices at the very short term, I would say after 6 months. Then once you get into a middle period, 6 months to 2 years, maybe stable. And then in a little bit medium term, you could see falling prices again. And so they're going back and forth wishy-washy on this. That's why I don't like using these type of things to talk about monetary policy because you're chasing a phantom. You're chasing lags. You're chasing data and forces that you don't know how to measure properly. That's that you know who would agree with me on that? Milton Friedman. And the monetarist perspective is you don't target these sort of things. You simply target a expansion of the monetary base. You target 2%, 3% expansion of the monetary base. Over the long run, in the short run, you'll have volatility, right? But over the long run, you're going to have more stability if you just target the quantity of money. But the problem is they don't know how to measure money anymore because it's esoteric. There's a lot of cash and cash equivalents, rehypothecation, repledging of cash equivalents. And so you don't know what the money supply is, what the effective money supply is. You might be able to say, okay, well, M0 is this, M1 and M2. We kind of know these things. We can measure these pretty well, but that's not the effective money supply. The effective money supply is the cash like utility, the total utility of cash and cash equivalents out there in the economy. And you can't measure that anymore because it's gotten so esoteric, so deep in the shadow system. And so that's why the monetarist perspective doesn't work. And going back to what was he saying originally? Oh, yeah, about the tariff thing. You don't know what the effects of the tariffs are going to be because what happens if the tariffs were hitting when we were in a natural decline of the price level? That's kind of what I think happened. Okay. We were sliding into recession. And I've talked about this for a long time. I was saying we're in a pre recession period. We're deteriorating into a recession. Then the tariffs kind of come in and kind of stop that slide of disinflation into deflation and level us out. Okay, so maybe that's where the missing quote unquote inflation is from the tariffs. It actually was stopping disinflation and stopping deflation. Do you guys get that? And so um, all of their textbooks, all of their models, that they don't take, they cannot know. This goes to Hayek and his information problem. Okay, the economy is so complex, nobody can measure everything. Nobody can know everything. There's not enough there's not enough bandwidth in our brains to take into account every little interaction going on in the economy. That's why Milton Friedman then he defaulted to saying, we can't know this. There is an information problem. We're going to target 2%, 3% monetary inflation, but we can't measure money because we have credit money and it's esoteric. So we're in a bind here. We're in a bind. And like Powell keeps saying over and over, we don't know. I don't know. They don't know. That's right. They don't. We're in a weird period. All we can do is kind of wait and see. And when I look at the charts, and some people might look at me, when I'm looking at the charts and I say, oh, we have to wait and see. We have to wait and see. We have to wait and see. I discount like a total crash. I also discount a total boom. We kind of have to wait and see. Our base case has to be sideways because that's been sideways and we're in this weird period. And people look at that and they go, oh, he's not saying anything. He's just saying it's going sideways. No, of course not. I'm not selling doom. The most popular macro people out there, they just sell you doom every single day. Oh, they didn't plan for the Strait of Hormuz. The total absurdity of that claim. Oh, they're going to ditch the U.S. Treasuries when we're breaking out like, every single Treasury auction is overbid by at least 2% or two times. That means there's two bids for every Treasury that is offered. It's usually like 2.3, 2.4. Sometimes we have 2.5 times overbid. So there's no lack of demand for U.S. Treasuries, but we're constantly told by these Chicken Littles that there's a total lack of demand for U.S. Treasuries. They're going to start dumping Treasuries. The dollar's going to go down. The dollar's going to die. And what do we see? We see the dollar stable. We see the Treasury yields stable. We see U.S. GDP growth above 2%. I thought the last two quarters of 2025 were way higher than they've been revised now, but it's still looking like the last half of the year was around 4% or so. We have a reindustrialization trade going on in the United States. So you have to zoom out. You have to look at the big picture. You have to consider everything that they're telling you, everything that you can kind of incorporate into a larger, broader framework, and that's what I do here. And I think I do so relatively successfully. So, anyway, let's continue. They're not in a difficult situation. They're keeping rates stable. They're doing nothing. They're not in a difficult situation. The situation is difficult to understand based on their textbooks, but that's completely different than saying that they're in a difficult situation. Just do what the market price is in. Boom. Over. Go home. Have dinner with your family. Tuck the kids in a bed at night, and then tomorrow come back and do what the market price is in. Like it's not difficult, Powell. It's just that you're having difficulty understanding, and everybody does. I don't understand it. Nobody understands it. It's way too esoteric. It's way too complex. The market is. That's why you have to zoom out. We're in a period where you have to zoom out and you have to look at the broader trends. And those broader trends are deglobalization and demographic decline. Deglobalization, demographic decline. Now, on top of that, you could layer AI, but that's a much more complex story about energy and type of population or type of demand for that and how exactly that's going to come through, if it's going to come through like we think, et cetera, et cetera. But the broadest factors are deglobalization, which this Iran thing and the Strait of Hormuz is part of, and demographic decline, which affects total demand in the world. So you're not in a difficult situation. Just do what the market price is in. But you're having difficulty understanding this because you're not thinking broadly enough, systemically enough. All right. Okay. Spag, you're asking TLDR for this stream. Are you still in here? Are people still hanging around? Yeah. TLDR for what? For the whole thing? The whole thing? Um, they kept rates stable. 6 weeks of data. Just what the number was. Oh, the number is stable 3.5 to 3.75. They're keeping it stable. That's what they cut, or they didn't cut. They maintained the rate. 6 weeks of data collection and back and forth and market shocks and everything. And the Fed says, oh, they're in a difficult situation when they just kept it stable. They did absolutely nothing. That's what they did. Nothing. But overall, the whole statement I would summarize as saying, um, almost like, he's agreeing with me in that I'm saying we're in a really weird situation right now. We're going through all these shocks. We're going through monetary problems, with gold spiking, and what's the role of Bitcoin? What's the Save Act? Is that going to get passed? What's the midterms going to be? We have the uncertainty of the Strait of Hormuz, and then Venezuela before that, uh, tariffs before that, COVID before that, stimmy checks. Is the TGA going to get plussed up and spent down? And how is that going to affect all these? There's all these temporary volatile factors on the economy, and they do nothing. Absolutely nothing. Zero, zilch, zippo. They keep rates the same. They write a few words for their post in their boilerplate. They added a few sentences to their boilerplate this time, at least, that had to do with the Middle East, but basically boilerplate. They changed like two sentences, added two sentences, something like that. That's how much they did in these last 6 weeks. That's how much they've done in the last 3 months. They didn't cut last time either. And the times before that, they just follow the market. So, like I said, their job is not difficult. Follow the market, do what the market prices in, go home, eat some dinner, read to your kids, tuck them in, wake up in the morning, go back to the office, do the same thing, follow the market, go home early, have dinner, spend time with the kids. Like that's not a hard job. That's not a difficult job. They're not in a difficult position at all. They're in a difficult position to understand it the same way we all are. We all are in the same position. Nobody knows the complexity of the market. And their problem is they don't really have a problem, but if the problem in understanding for them is they don't have a more generalized theory of human behavior. They're textbook economists, PhD economists, sorry. And they don't look at human systems. They don't look at the broader things that are going on with deglobalization and depopulation. So nothing is the best thing for politicians to do. Absolutely, man. I used to love it when there was gridlock, because when gridlock happens, nothing that they don't make things worse. But I do want this SAVE Act to get passed, um, because I think it's important to make sure the integrity of the elections. If we have this system that we have today, which I think is proven itself over the last 5 years. A lot of people say like the Constitution has failed. I don't think that's the case. I think it is designed to bend, not break. And so you can have these like rogue politicians that cheat on elections, but then if there is, divine intervention in Butler, Pennsylvania, and Trump comes up and says fight, 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 then he can still get elected. And then he comes up and is like a bull in the china shop and he's making things happen. And then you have these rogue judges, these district court judges that are trying to legislate from the bench and try to overstep, uh, you know, the separation of powers and basically take control of the executive branch through judicial fiat. Then there goes to the Supreme Court, and Trump is like 28-1 at the Supreme Court, and they're slapping him down. And then the Supreme Court rulings go back to these district court judges, and the district court judges completely disregard the Supreme Court and do something else. And then there has to be Supreme Court has to come down on these judges internally within, like, say, a judicial branch, even though district courts are a part of the legislative branch. So there is fighting going on, internal fighting, external fighting, bending, but not breaking. And I don't think we're anywhere near a civil war. I think if we get the SAVE Act passed, um, the elections are going to quickly turn into a 60-40 affair, quickly. And the radical leftists are going to be kicked out of the Democrat Party. And the Democrat Party might totally go away. I don't know if it can recover, because so much of the old Democrat platform is now MAGA, right? MAGA is the old Democrat Party to a high degree. I would say it's MAGA mixed with like evangelicals or something, or it's old Democrats mixed with evangelicals, something like that. It's the center. It has everything that is right of center left. So it includes the center left, it includes moderate left, it includes moderate right, center right, all the way to extreme right, except for the rhinos and the old school neocons that they kind of are still fighting, but they don't like it, but they are part of the Republicans and part of the right at this time. So there can be no Democrat Party, because all they have left is the extreme left, the 25% at the extreme left. That's what they're pandering to. That's how they think they can get elected. They also have the illegals and they have counting of the votes and things of that nature. But that Save America Act is going to hopefully address those things. And so, um, is a Democrat Party. I think in one foul swoop, this could get rid of the radical leftists in the United States. It's going to take a generation to get them out of academia and out of maybe local governments and even state governments and stuff. It'll take a generation, but for all intents and purposes, the Democrat Party is dead, and the radical leftists are dead. Not dead; they're figuratively dead in that they will never win another election, because this is a 60-40, even 70-30 country. And yeah, so that's you got me on a rant now when you say that's what best thing for politicians. But okay, so that's where I'm going to leave it here with Nick Timmeros speaking, and I think we got a flavor for what that's worth. I am live streaming on YouTube, Twitter, and Kick as well. I want to build up some sort of Kick following, and then maybe do like longer term podcast reviews on there, like a streaming thing. So I do not reviews, but podcast reactions live on Kick and YouTube, something like that. I don't know. I'm keeping my options open. I also recently set up a TikTok account, guys, for Rogue Macro. So you guys can find that. It's just Rogue Macro on TikTok. And I've been putting out my shorts on YouTube and TikTok. And I hit a couple with Cuba stuff, hit a couple algorithms and got a couple hundred views on TikTok. So maybe that can grow and that can expand the channel. Also, remember I'm putting stuff out on the podcast feed. So check out both Bitcoin and Markets and Rogue got a podcast episode put out yesterday. So anyway, trying to make a little push. I've created myself some organization and trying to keep to that. Of course, remember the pro tier is now getting a weekly report or weekly missive over there on Rogue Macro and Bitcoin and Markets. That's every Friday. So going to be continuing with that. And what else? That's all. Let me just check and see if any comments came through, and then we'll bounce out of here. Yep, that's it for today, guys. Thanks for hanging out. Like, comment, subscribe wherever you're watching this, and I'll see you guys on the next one. Bye.